Hello and welcome to another video in my journey of trying to become a successful investor with no experience, no education. Basically don't know what I'm doing, so doing a vlog of my journey to see whether or not I can in fact become a successful investor. So basically everything I say don't take seriously because I've got no idea what I'm doing. But this video here, I come across Alexandria real estate, so it's a REIT. Now, I've got to be honest, I've seen a few REITs in the past come up through my screeners, and I've never really understood how to value them. Well, that's sort of changed with my now usage of AI. I use ChatGPT a lot, so I've took a little while with this one, actually sit down, try and figure out how to value a REIT, figure out how they work, because it's not really a concept that was very familiar with me. Now, as you can see, this stock price looks dog shit, if we're honest. It's declined an awful lot from peak to present, 75% of its value. So yeah, it looks awful. Exactly why it's turned up on my screener. Still big market cap though, 10 billion. Now, I'll run through this one, tell you what I see. You should ignore it and certainly shouldn't invest on it. But I actually quite like this one, but don't invest on this because, like I said, I don't know what I'm doing. I'm literally just some bloke trying to vlog his journey, so that should I be able to one day become a successful investor, then there'd be a blueprint for other people to see. I'm just vlogging my journey of waffling on, talking a load of crap, not really knowing what I'm doing. So we'll crack into this one. And we will talk through the points where I tell you what I saw. So annoyingly for me, there's been no insider purchases within the last 2 years. I always try to start off, I suppose, on who owns it, and unfortunately, nobody has bought in the last 2 years for ARE. I do find that quite disappointing, actually. That is a negative to all my investment thesis. If the management aren't aligned, like if this was cheap, surely they would be like slamming some money into this, thinking, come on, there's certain profit when the market realizes here, and they're not doing it. So big negative straight off the bat, unfortunately. There's no huge funds involved either. There's only one above 4.5% of their portfolio, and there's several in the preceding deciles, which I'll show you here. Oh, keep doing the wrong one. Show you here on Whale Wisdom. Holders, percent of portfolio. Oh, there's one now, 5.6%, 5.06%, but yeah, 4.5, 4.3, several in like the, a few in the threes, a couple in the twos, there's a lot around about 2%, but there's no one with any real conviction. And unfortunately, the usuals, Vanguard, BlackRock, State Street, are the people that own the most of the business. Now, I don't need other funds to be able to see what I see, but it is nice when there's other investors that you respect seeing the same thing as what you do. And to be honest, I've heard of none of these. And at 5%, is it really big portion of your portfolio? Some would say yes, but for me, it's not when you've got like Monish Pabrai with like 16% in a stock, or Norbert Liu, was he got 17% of Crocs, or 70% of his portfolio in Crocs. That's the sort of investor that I respect, and that is a sort of confidence that I like to see on side, if possible. But there's nothing like that with Alexandria real estate. One thing that I have noted though, right, I like to look at the bond prices as well, because I feel like bonds are I wouldn't say a prediction of the future, but if they're trading at close to par and they don't mature for years, then the overall market is obviously saying that, we think that there is something to this business. Now, we get the bond prices up on FINRA. They got quite a lot. It is a heavily indebted business, but if we go to anything maturing in the nearish term, they are all trading around about par, and the ones that are low, like here down in the 60s, that's in the 2050s they're maturing. So even in the 2050s, the majority of people, I would say, are semi-confident that they will still be here in the 2050s. So when you see bond prices literally at par, above par, I take that as a big positive. That is something that I learned from Keith Gill from Roaring Kitty. If you've ever watched any of his videos, if you stumbled across mine, you've probably watched his because he's a miles better investor than I am. But yeah, that is a positive sign, I say, when people are that far into the future and the bonds aren't trading into the ground. I like that. That's something I like to see. So it's a REIT that owns and leases out scientific property that is used for things like high-end laboratories and research facilities. So if you're wondering where I'm getting this data from, I'm getting it from ChatGPT. Now, I'm not an experienced enough investor yet to be able to find all this sort of stuff in the statements. I probably should look into that, but ChatGPT gives you links and everything. So I rely on it a lot. I don't take the veracity of its data, as gospel, but they're saying that the majority of the tenants leases span from 5 to 15 years. So that's pretty good. So the company has lost earnings and funds from operations. They've also cut guidance by almost 50%, from $2.57 a share down to $1.36 a share. So obviously that's not good. Occupancy rate of their buildings has dropped slightly from 94% down to just under 92%. And the sector that they rent to, obviously like pharmaceuticals, that sort of thing, anybody with laboratories and research facilities, it's currently in a tough period for funding and dynamics and all that, and regulatory framework as well. So some analysis shows that it's been overvalued and dividend yield may have crept too high and become unsustainable. We'll go into that into the future, but historical dividend levels, if they kept it as is, like what is it, around about $5, I think their historical dividends is, and the dividend yield currently at current prices would be about 9%, which is obviously really high. Very good dividend yield. That is if they keep dividends as they are. So the revenues have slight declines and forecast to continue declining because of industry pressures, but the revenues have doubled since 2019. So I've got it in my spreadsheet here. Have I got the right spreadsheet up? Gone on here. That should equal that. There we go. So yeah, revenues of around about 3 billion. They were 1.1, close to 1.5 billion in 2019. Semi-consistent, the last couple years. So that is something. Gross margin historically has been very good in the 70%, and SG&A margin has been cut currently at the lowest level ever. So gross margin, like I said, around about 70%, and it's sustainable around about 70% as well, which means that their costs of sales and all that sort of thing, I suppose, is pretty good. SG&A margin, like I said, down at 7%, down to just under, just over 5.5%. So that means that's good, I suppose, that they're trying to cut costs. I'm trying to do this in a logical order, which is why I've set it out as I have I'm pointing at the screen then, as if you can see it. You can't see it. As I have in my notes here. So there are future risks to the sector. It rents, the people that they rent to generally is facing tougher funding and dynamics. 30% of rental spaces faces renewal in 26 to 28. So that is obviously, this is during a tough time for biotech as well. So that could be something to keep an eye on for certain. Occupancy rates have fallen and only 53% comes from investment grade large biotechs. So, that's a lot of exposure to smaller biotechs, particularly considering the soft macro picture. So the smaller biotechs obviously do not have the weight of the larger ones to survive. I guess is what we're saying is a risk there. And when new tenants come into the properties, they require extensive refitting to suit their needs. So, they might not be willing to pay that at the moment if the framework is as it is. And they're also actually selling properties at a loss. So you go on the balance sheet and it says, not the balance sheet. Let's get it up here. Financial statements. Where's the latest one? Wrong one. Here we go. So where is it here? they have got gain on sale of real estate. See, so 22 million so-called and a gain on sale of real estate lately. But when you actually dig into that, it's a slightly different story, because before they get sold, they put it into a assets held for sale section, and then they have to get reevaluated. And there's been huge impairment losses recently because of that, where they've tried to sell an asset, put it into the assets held for sale, it gets valued, and then it's, you know, cut down from what it's actually being carried as on the books. Now, that then goes on the books as a new book value price, I suppose, and you know, a new asset value. Sorry, should I say? When they sell it, if it sells for more than that new asset value, it actually goes down as a gain on sale. But actually, you could have had a significant loss if it was impaired down significantly, say 100 million, but then they make 22 million on top of that new value. It goes as a gain on sale when actually they've lost like 78 million compared to what the value that they had it as before. So that is something that you need to keep an eye on. That's something that I've learned, like I said, because REITs is something that I have semi-learnt very, very recently, basically while I was looking at Alexandria real estate. And they've apparently also got 1.5 billion in venture capital investments, and it's mainly in the biotech industry. So I don't like that at all. Biotech is not something as a value investor that I'm interested in. I think there's a lot of risk in the biotech industry, especially with venture capital investments. You're almost guessing that stuff's going to get, you know, past the regulators and all that. It's not something I like. And TTM, they've recorded a 50 million loss from these investments. There is so-called potential for a dividend cut on the horizon. I read in one Seek and Alpha article, but I'm not sure I quite concur. But then I could do, I suppose, if occupancy rates fall and you know, they lose some business. So they're going to focus on fewer high quality assets with mega campuses that they rent out, selling non-core land and development exposures, cutting costs and locking in longer term debt. So they're positioning for resilience rather than ignoring the weak environment. This will take time to cycle through to earnings. Investors should watch whether these initiatives translate into improved occupancy, rental rate growth, or development yield, reduce cost pressure, and stable FFO and AFFO. Now, that's something that I have recently learned as well, because I always use free cash flow. Apparently, you don't use that for REITs, so we'll go into that. Balance sheet wise, right? And this is where you've got to take it with a pinch of salt, like I've already explained, that stuff is held potentially. It's weird for real estate, right? Because you just assume that real estate always goes up, but they've had huge impairment losses, which means it's been held for higher than what it actually is worth. So yes, it is double, and tangible book value is double the current price. So that is good. To me, it signals balance sheet strength, but there's also like a little caveat to that you've got to be aware of. So $55 currently, and book value is 124, tangible book value is 124. So that seems really good to me, you know, that you've got that. Whether or not it is, I suppose, remains to be seen, but I do like that. I do like that the book value of the properties, with the caveat of the impairment thing, is considerably higher than the stock price. That is something that I am quite happy to see. There's a very large amount of total debt, but it's mostly back-ended. Less than 15% matures before the end of 2027. And current free cash flow is over $1 billion higher than interest expense. So I have got current... This is what I mean, though, because this is where it gets a bit iffy. With free cash flow, apparently you shouldn't be using it for REITs. So I've got around 1.3 billion in free cash flow, and the TTM interest expense is only 161 million. So that's more than covered from free cash flow. So that is a big positive for me. And like I said, less than 15% matures before the end of 2027. Just over 1.2 billion is due before the end of 2027, and 1 billion before the end of 2029. It appears their debt maturity is structured well, and free cash flow should cover it. How much cash do they hold as well? Like $500 million, almost 600 million in cash. So, you know, liquidity wise, they're pretty good. I got a feeling they've got a revolver as well. If I put that in my notes, I can't remember. So liquidity wise, they're pretty good, and their debt is structured so it is quite far out into the future, which I'm guessing is probably a positive for the bond prices as well, knowing that it's not all going to come due in one go. Income statement. So despite pressure in the industry, Revs TTM are only slightly down. Huge impairment charge of 485.6 million has caused net income to become negative. Obviously, that is not something that has actually affected the cash, so it will be added back in free cash flow. Free cash flow only turned positive. We're now down onto the cash flow statement. Sorry, free cash flow only turned positive in 2023, but it's gone from 500 million to 1.3 billion. I don't like that stock comp is so high, 45.3 million TTM. I'm not big stock compensation person. I'm not sure most value investors are, to be honest. I agree with Warren Buffett that if you're being paid it, then it has to be an expense, which it obviously is to shareholders because through dilution and stuff like that. It's very difficult, I found as well. I'm sure maybe if someone watched this video, they can help me out because I do like the look of this company. I can't really find any comparable REITs. They all, like in this industry, lease into labs and all that. They most appear to be privately owned. That's according to ChatGPT and doing a little bit of Google searching. So we're going to get into the forecasting side of this now. The forecast data is sparse, with Simply Wall Street implying a modest 0.6% growth per annum for the next few years. This seems high considering revenues have dropped and the industry AR operates in is under pressure. For this reason, I've dropped my the number that I would forecast lower. As we've seen, revenues are around about 3 billion, but I've gone for at least 250 million less in my forecasting. So free cash flow margins have historically been very negative. It's only in the last 3 years has this changed and turned positive, but it has become, significantly positive, 18%, 39%, 44%. It's very difficult to forecast this forward considering the newness of the positivity of it. So I say I will probably use 30 to 50% of that free cash flow margin. When I forecast, so hang on, let me just see what I was going to do because I've got the last ones in my forecasting at the moment. The last stock I did, the 2.75 billion forecasted going forwards, 27. And then I said that I was only going to use 50% of the margin going forward. So here we go, 0.5 and instead of 0.8, 0.5. That's still forecasting simple free cash flow of around 500 million, which is obviously with the interest expenses 161. That's huge. Now let's go dig a bit deeper into that. Using 50% would take current margin down to 16, well, just under 17%, a steep drop from the current 3-year average of 33%. That gives 464 million in forward free cash flow and a multiple of 21, which would make it currently around fair value, looking at the average multiples that it's traded for. This will cover interest expense, though, given an interest coverage of 2.8, so still pretty good. Interest coverage of 3, I like to see at least, so we are around about that area. If you used 80% of that margin, assuming that they've turned their corner and they're free cash flow positive now, and they're going to continue to look that way into the future, run the business that way. If you used 80%, then it would take it up to 27% of the margin, and you'd have 742 million in free cash flow, and then you'd have a multiple of 13, so you give a possible upside to the average of 20% of 60%. So with 9% dividend yield as well, currently you could have on those forecasts. Now, like I said, this could be dog shit forecasting, so take no notice of it at all. But I'm just showing you my workings in the hope that someone could turn around and educate me more and say you're doing it wrong. Basically, that's why I'm showing my workings, try and meet people to network with, I guess, and help me on my journey. But that could be a 69% rise. ChatGPT and Simply Wall Street believe the dividend to be reasonably well covered with no need for a cut on the horizon. So for 2024-25, typical dividend yield for a healthcare science REIT was 4 to 5. So Alexandria Real Estate's dividend of around 9% is very good with the way the price is currently. Like I said, asset-wise, it seems cheap, but then obviously you've got to bear in mind the impairments. Nonetheless, for assets, it seems cheap, and free cash flow that is severely hampered should cover interest expense. Cash on the books of 500 million should help, but it could hamper. Should help. I don't know what I wrote there. Could hamper maturities. Don't know what that means. So Roaring Kitty said that people will generally pay around 20 times for dividends. He said, I can't remember which video he said that in, but I have heard him say that. So, 20 times for dividends, dividend of currently 519 per annum, that would give another share price of over 100. So you've got the book value of well over 100. A dividend multiple could take you to over 100, especially like if you're paying 20 times with a dividend multiple, you want to know that they can actually do it. And if we're saying that they got enough money to pay the dividend, then why wouldn't you give them, I guess, a good dividend multiple? So book value over 100, dividend multiple over 100. We've got potential upside on the free cash flow. So, it could be a good long-term play. If it gets much cheaper, it's likely, to me, a good buy. If it isn't a speculative buy already, I would say it is a speculative buy currently, because you just don't take anything I say seriously. For me, the thing that pees me off is that there's no insiders, because if all of this was to be true, surely the insiders would be seeing it too, and then taking note of that and trying to buy. And I'm not seeing it, unfortunately. So ChatGPT has taught me about using implied value, property value, and also using AFFO. Now, to get the implied value, I have got let's see, let me just bring it up on another screen. Another thing as well, I'm going to say, like, a REIT with low debt maturity risk should trade around 1 to 1.3 times book value. So that is a historic thing that I've read about. Relative to equity book value as well, not enterprise value, because obviously the enterprise value for ARE is considerably higher, but that's apparently talking about equity book value. So that's another thing in the positive book. So where are we a minute? Back down to this. So I've net income currently over the last 9 months. So this is from the SEC. Net income. Yes, we are 9 months negative, considerably negative. Like I said, we've had huge asset impairments that are in that as well, mine. So that has to be read about. So she got it higher there than what it was. But anyway, net income. Apparently, you add back in depreciation and amortization to net income. Add back in interest expense, add back in any impairments, and take away any gains on sales. So this is only for 9 months. So I've had to times it by 1.33 to get an average, an estimate of the 12 months, which would be, this is all in thousands, by the way, so it would be billions. So you've got to then use a cap rate, divide that by a cap rate, and that will give you an implied value before the debt. Now, if you minus the total debt and then divide that by the share count, I'm getting an implied property value of 112.5, which is obviously considerably higher than what it is now. Now, the only thing with that is that's assuming that things are going to stay as they are, when we know that there's industry pressures. So that is, take that with a pinch of salt. I'm just showing my workings in the hope that someone can tell me I'm wrong. Let me just try and find. I got my document up here. Here we go. Drag it up. So AFFO. So start with FFO, net income plus depreciation, amortization related to real estate income statement, plus impairments, plus or minus gain on sale of real estate. So you add back the losses and subtract the gains. And then to get AFFO, you adjust for maintenance capex. So you minus the maintenance capex and recurring adjustments. So we're just about to go on to AFFO, so I'm showing you this. And then you find out whether or not, if you take away the dividend or the dividend coverage, dividend per share divided by the AFFO per share. So apparently you want any dividend coverage ratio of under 70 is good. Anything over 90 is risky. So my AFFO, start with the net income, added back the depreciation, added back the impairment, minus the gain of sale. And I've got FFO here of 141. What's that, 1.4 billion. So maintenance capex is difficult to find. I believe that Alexandria Real Estate actually do show their maintenance capex, but to be uber conservative, I've used 20% of 25% of FFO, so that is apparently really high as well. From what I have read, it's normally around about 10%, or where is it here? Typical maintenance capex for REIT type alerts. So this is an office and life sciences, 5 to 10% of net operating or revenues. So if I am using something considerably higher than that, then it's very conservative, which I think is good. So minus maintenance capex, and then I've times it by 1.33 to get to 12 months, because this is again the 9 months worth of data, and I've got AFFO of around 8.32 a share. So 5.19 of the dividend divided by 8.32 gives a dividend payout ratio of 60%, which is very good. If you were to take away the interest expense, you got a 1.1 billion buffer for dividends, so dividends are reasonably covered. My maintenance capex is apparently very high per ChatGPT. So it would be more like, according to ChatGPT, more like 216. Well, I've obviously used 354. So that's billions. That'd be 354 million. Sorry, I'm getting confused here with my own writing. So, I've used what is supposedly a considerably higher maintenance cap level, and that would actually end up with $9.40 per share of AFFO. So historical multiple, normal multiple is 18 to 25 EV to AFFO, and I've got that from, how do you pronounce his name? Aswaf Damodaran's website. He's got actually sector by sector EV to like free cash flow or whatever multiples. So he said that the norm for this type of REIT, specialty REIT, is 18 to 25. So currently, with the EV as it is, 23 billion and the AFO of 1.4 billion, that's actually 16x. So it's slightly under this 18 to 25 that's on a normalized basis. There are things in this that look like it could be undervalued. To get 18x, do AFFO times what I wrote there, then subtract total debt divided by. I don't know what I wrote there. So that would give a conservative price of $66 if you were to do the AFFO per share, times it by a normalized, say, 18. Then that would give you just under $67 a share, which is obviously higher than what we're at now. Now, all of this, I have to say, is done on a reversion to mean basis, in that it's currently cheap. Yes, the industry is terrible, but in the future, it should revert to mean. If you were to use 10% maintenance capex, and that would take it up to $86 a share on AFFO. So implied value, AFFO, net present value of free cash flows, which is what I showed to start with, all suggests this stock is undervalued on a reversion to mean basis. So that is on an assumption. That is on an assumption that that the industry will improve. This is a Howard Marks thing, isn't it? Eventually everything reverts to mean. So that is where I am at with ARE. If you've got any questions, please ask, because I feel like I waffled a bit there, especially when I got onto this part. If I were you, if you do not understand using implied value or using AFFO, ChatGPT, and you can make them dumb it down as much as possible to suit your required learning needs. It took me a while. These are all my notes here. You can just screenshot this from ChatGPT conversation on how to value REITs. Is there anything else here that's worth talking about? Not off the top of my head, I don't believe. But yeah, difficult one, right? on a reversion to mean basis, I feel like this could be something. Do not invest on that at all, because as you could probably tell from my waffling, I got no idea really what I'm talking about. But if there is something here, you know, please speak up. It would be interesting to see if anybody else agrees, because actually I think on Seeking Alpha a lot of them don't agree. But it depends on how, you know, short-sighted, I guess, their approach is. Like, I agree, currently looks terrible, but if you were to wait 2-3 years on a reversion to mean basis, is there something in it? Potentially there is, because as I said, all of my figures are done on a reversion to mean basis, in that occupancy rates will stay good, prices of the properties are semi in line, you know, with the book value, which we of course know they aren't because we've got impairment charges, but it is what it is, you know. To me, it looks like it could be undervalued, but don't take that as anything other than the ramblings of a wannabe investor that has no idea what he's doing. But yeah, ARE, any comments, please? I'd love to have a conversation about this one, because to me, there could be something in it. Even if there isn't, right, a 9% dividend yield is really good. And maybe in the future, the stock price returns. You know, there's something in a 9% dividend yield for a lot of people. If I'm correct about that, I could be wrong. If I'm wrong, tell me. But yeah, there we go. Alexandria Real Estate. Thank you very much for watching. Like and subscribe. And we will see you on the next one.